Welcome to Nasdaq Trade Talks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Max Cabasso, Managing Director on the Nasdaq Market Intelligence Desk, Phil Mackintosh, Chief Economist at Nasdaq, and Sam Miller, CEO of Kasheesh, is back with us. We're here to discuss how consumers are their spending habits and stretching budgets through BNPL and multi-method payments. It is great to have all of you with us. Welcome back to the show. Sam, your data compared to last quarter certainly has shifted a bit for consumers. What are some of the highlights here?
So we're seeing a huge decrease in discretionary spending. So we're seeing the mandatory payments that they have to make, like rent, mortgages, and taxes, increasing from 50% to 60% of our payment volume. So that's a 20% increase month over month from what we're seeing, and we're seeing a huge decrease in the discretionary side. So if you look at some of the payments that we were historically seeing from Amazon, Costco, Walmart, we're starting to see those dip quite a bit and move more towards the mandatory payments that they have to make. We're also seeing a significant boost in paying off BNPL loans. And so where we were at 0.5% of our payment volume, we're now at 4% in that same time frame, which is a pretty drastic increase of just buy now, pay later loans.
Let's take a step back for a moment here. Yeah. What type of data is Kasheesh aggregating for some context?
So for context, we get the data from all of your underlying payment methods. So if it's your credit cards, your debit cards, you're linking your accounts that you have linked with your other financial institutions to us. At some points in time, we can actually even see some of the loans that you have, whether that's student loans or mortgages. We have all of that consolidated under one roof. So in typical instances where you're looking at an individual financial institution's data, that's proprietary and bespoke for just that financial institution. We have all those financial institutions consolidated under one roof, so our data gets to have an objective look across the market and not just at the data that you have access to from one financial institution or another.
Right. So Phil, how does this compare to the data as an economist that you're looking at that's produced by the government and other surveys?
Yeah, I mean, I think some of the data shows some weakening. We were looking the other day at the fact that when you're looking at the spending, really consumer spending is starting to be driven more and more by the upper income. And it looks like lower income are finally starting to really slow down the growth in their spending. Wages look like they're starting to pivot from increasing for low income and not so fast for high income to the opposite. So I think maybe that's feeding through into the data that we're talking about, where the low income households are the ones that are probably really struggling. The data that I've seen is a little bit different. I mean, the revolving loans definitely look like they're having more delays getting paid and more delinquencies. But the housing loans don't look, in some of the data I've seen, like they're changing that much, which kind of is consistent with the fact that a lot of people during COVID had those super low mortgage rates. They reset. A lot of people still have sub 3% mortgages. So even with interest rates coming down last month, there's still not a lot of incentive to sell your house, move to a smaller house and pay a higher mortgage. So we've still got a kind of slow property market because people haven't really got the incentive to like switch to a new mortgage. But by the same token, the interest rates there haven't moved for a lot of the people with mortgage loans.
I mean, anecdotally, you see houses sitting on the market longer.
Starting to. Yeah, I was reading this morning about affordability, which we've seen affordability charts off the charts for a while. You know, the affordability now is a little bit like 2008. When you've got high interest rates and expensive houses, that's going to be hard to afford a house. But maybe that's also what's holding up the rent part of the inflation story, right? Because no one can afford to buy a house, no one can afford to sell a house, so all the people that are coming out new into households are having to rent.
Yeah, we're seeing the majority of those consumers having to rent and not being able to buy, so that aligns perfectly with what you're seeing. I mean, if you also look at the fact that right now from just the consumer market, you have 50% roughly of the entire consumer market, especially in retail, is being controlled by 10% of the population. And so I think that there's also a little bit of that bleeding into some of the housing crisis that we're not seeing, where you have a good majority of the housing market being determined by a very small subset of the population.
Yeah. And Max, that's what makes it confusing, because we're sitting here with markets at near all-time highs, but as the everyday consumer, it doesn't feel as exuberant as the market might suggest.
Yeah, we've talked about it plenty of times here. Obviously, I've had this conversation a lot with companies recently. Equal weight versus kind of regular weight, especially for the S&P, the underperformance of the equal weight. We kind of got back together in April after Liberation Day, after the sell-off, and then it has continued now to regain. I think it was, last check, it was about 10% underperformance essentially since April. equal weight has underperformed the regular S&P by 10 percentage points. So again, it's that Mag 7 AI trade is really keeping the markets floating where we are now, near just under all-time highs. But again, with the consumer, we've talked about it's kind of that, it depends how you're looking at it. Are you looking at the kind of higher earners or the lower half? And that's where you're starting to see that bifurcation. We talk about even housing. Certain areas of the market, more expensive areas, they're still okay because the higher earners are still handling it. Whereas lower income, the availability is not there for in the supply side, and rates obviously still hurting. We saw a dip in rates, but it's kind of cooled off and gone back the other way. So they're not getting that relief on the rate side. So it's that kind of dual economy essentially. The market looks great, but it's kind of the high flyers that are carrying it. Same with the consumer. It's the high earners that are still able to carry that load when the lower starting to slow down. We talked about before we were here about questions, Google searches for help with mortgages. You're starting to see auto loans, again, more subprime. Obviously, those numbers are not where they were in 2009 in the sense of the number of subprime loans that are out there, but you're seeing delinquencies going up in the auto sector as well. Again, not to those extreme levels yet, but you're starting to see that uptick. And again, it's kind of showing there are some cracks and that those lower earners are not able to continue on with that growth in spending to keep, kind of fueling the broader economy.
One thing to piggyback off of your point about the Google query that we noticed was it wasn't necessarily about originating a new mortgage or to buy a house for a first time. A lot of those consumers were actually doing that Google query to figure out how to manage what they currently have as an expense. So whether or not it's to do a HELOC or to refi, when they said help with mortgage, it wasn't necessarily just to get a mortgage, it was also to manage the existing mortgage that they currently had. And so even they're struggling in some capacity of trying to figure out, do I refinance right now? Is there a different rate that I should be waiting for? Is this the right time to sell, or should I be holding out? And so there's a lot of confusion from the consumer end of what do I actually do outside of just buying or selling the house itself.
I think there's probably a bit of, especially the adjustable rate mortgages, primarily everybody expecting years ago, okay, I'm just going to lock in, an adjustable rate, and in 3 years, rates are going to come back down. We've kind of been waiting for it, talk about it. Rates will be back down lower in the 4s, maybe, low 5s. All right, I'll just refinance then. And then it comes to the term, all right, time to refinance, and wait a second, we're actually a bit higher than we were, or essentially the same place. That refinance is not great, and now I'm locking in at this higher rate. That's not what I anticipated. I expected my payments to essentially go down in a few years. When rates came down, that hasn't happened, so it's not giving that kind of boost of additional discretionary spending. If your home payment went down, that's just not happening.
Well, plus your insurance and tax assessment costs went up as well.
That for sure.
For sure, especially on the insurance end. It's interesting, Phil. I mean, we've gotten the rate cut. Besides savings rates getting cut, you haven't really seen it on the
mortgage side. It hasn't really come down, has it? I mean, I've seen people talk about the fact that because we can refinance loans in America, there's like an option cost built in when rates are high, because the banks that are lending right now know that if rates come down a lot, then all of us will rush and refinance, and so they'll actually lose out on those mortgage spreads that they're locking in now. So it's a little bit difficult to manage from an asset liability sort of timing perspective, and that gets priced in to keep the mortgage rates a little bit higher when the rates are higher, which to your point is the last thing you want when the rates are actually starting to hurt people and the refinancing is coming through and it's not falling fast enough, even though the Fed is trying to make things more affordable again.
But if we get to 4%, that suggests that there's bigger issues than just the housing market.
If we get to 4% mortgage,
if
or
4% mortgage rates, that means there's been a lot of cuts in between.
That means the Fed cuts are down a
there's
lot further
something
than
under
they
the
are
surface
now.
there besides just affordable housing.
That's the risk, right? If we do end up with 8 or 9 Fed cuts, it's probably because we have a recession. What we really want is what the dot plot shows, which is 2 more this year, 2 or 3 more next year, and get us to a rate 3.5-ish%. Inflation hopefully comes back down to 2-ish%, and that's probably about neutral. And that's probably about right, because we still have pretty good unemployment, even though unemployment's starting to go up, and we have inflation pretty close to 2%. The Fed is pretty close to Goldilocks, so interest rates should be at Goldilocks, not as high as they are right now.
Yeah. As it relates to BNPL and other alternative forms of payments, does that impact your credit score in different ways?
Yeah, so FICO's already started to calculate it as part of your credit score with FICO. I know that there's been some legislature that's trying to get passed. It's a little bit difficult right now with what's going on with government employment and the CFPB, but it is being factored into it. The one thing that has remained sound is that banks are actually looking into that as a reason why to reject you or why to accept you, whether that's as a deposit client, but more specifically as a credit client. Is it worth lending you additional capital? And if you just look at the past week alone, I think that Klarna is down over 14% and Affirm is down nearly 6%. And a lot of that has to do with not only the delinquencies, but you're starting to even see a shift in how they're trying to do fundamental business. Klarna just announced that they're about to become a cell phone company. And I don't think that people are sounding the alarm the way that they should. If their bread and butter is to take one payment and to spread that over 4, 6, or 12 months, and now you're moving into a business model where we're going to expect something out of you every single month, but you can't spread that. I mean, annuities are something that if you spread those over time, they compound and eventually you owe more than the original payment was actually due. And so if you're abandoning that business model after an IPO and saying that we're going to move into a sell space, I would say that that's more of a sign of where the consumer market is heading than anything else, where they're trying to lock in very reliable, consistent annuity payments, and they're abandoning the alt finance mentality of spreading something over the course of a given amount of months.
So if I understand it correctly, because BNPL doesn't suggest longer term credit or credit worthiness, if you will, because the longer you hold a credit account, the better it is for your credit report.
Yeah.
So it could adversely affect your credit report if you have multiple BNPL accounts on your credit report.
Multiple BNPL accounts, and also one of the biggest criteria is how long you've had your oldest credit card.
Exactly.
And so if you're constantly taking out new loan after new loan after new loan, you're refreshing that statistic over and over again. And so that can do nothing but negatively impact your credit score over time.
Yeah, well, I mean, then kind of blows up the whole mortgage argument as well, because if you're not able to, if you're not credit worthy enough to get.
Yeah, I mean, the biggest issue with it is it's a lot of silo data. I think that now that Klarna and Affirm are both, they were the both two unicorns, the giants in the market, and Affirm was public and Klarna was private. Now that they're both public and we're going to be able to look at earnings reports and quarterly reports, we'll start to see that data in a little bit more of a real time than we were previously. But I still think that the way that they calculate a delinquency for them is by definition if you go delinquent on your most recent payment. So let's say I took out 3 loans in order of A, B, C, and I'm delinquent on B. That does not factor into me being delinquent because I have the freshest version being C. And so even the data that they're reporting in those quarterly reports and those earning reports, it's convoluted data because they're doing it in their benefit. On the reverse side of it, a lot of their business is selling off the collections. So if someone does get delinquent to the point where it does need to go to collections, they're selling it to an agency, they're not counting it towards their P&L anymore, and they're making it someone else's problem. The second you go to collections is one of the most detrimental things you can do to a consumer's credit score. It takes roughly 7 years to get that mark off your credit score even after you pay it. You have to report to the bureaus, you have to deal with the fact that you have to submit that invoice, it has to get approved, accepted, and then your score gets adjusted again. And so I think that there's a lot to the consumer market that we can directly correlate to what's going on with BNPL. Factor in the fact that 10% of the population makes up 50% of our retail spend right now, and the market is still going up and to the right on the retail side of the fence. It has to do with the fact that we're inflating a lot of the retail numbers because of these BNPL payments, and the 50% that's based on the 10% is just holding the rest of the ceiling up.
Yeah. Max, this is what we talk about all the time. Never mind the larger consumer confidence numbers, but how they're spending and what they're spending on.
How, what they're spending on, and who it is that's doing the spending. Again, it's, we talked about it earlier today, just the split of who's actually doing that spending. They have the capacity to continue that trajectory up to the right where everybody else might not. And that gets very convoluted. Again, that number might look one way, but when you kind of go under the hood, it's almost like credit default market, you know, or CDS back in the day in 2009, when you actually look at under the hood what's actually being packaged up. You might have some really good stuff that's in there that's holding it up, but there's also going to be some junk that's in there as well. That kind of, when you just look at the top line numbers, it's not telling the whole picture.
What would happen if you remove that 10% of the population right now? What would happen to the rest of the data?
It would go bye-bye.
Yeah.
It would go down.
Not be nice.
That's such an intelligent way to put it.
It would always have gone down, though. I mean, the richest people are going to spend the most money.
Yeah.
But it is slightly getting stronger in terms of the difference between the low income and the high income.
Aren't we seeing that though too with GDP, where consumer contribution is lower and let's say tech spending is higher?
I mean,
we're seeing
what's interesting is there's so many places in the economy right now where the average data looks quite good, but you start to look in the details and it's not as good. It's like you talking about the equal weighted index. I mean, an equal weighted index says the average company is not doing that well compared to the index itself, which is overweight the large companies, that's an AI spend thing. It's the Mag 7's sort of stretching out into some different companies now, but it's all about chips and fabs and refactoring the AI models. There's not so much revenue coming through a lot of the smaller cap companies. Having said that, we are starting to see an uptick in earnings revisions and earnings in the small cap space at last, and I think the reduction in Fed rates is going to help that.
It is, when they say that the market's not the economy and the economy is not the market, it is so true. It really is. I mean, if you were to like take a step back and look at where the market is and then how people feel, like sentiment surveys,
yeah, I mean,
it's glaring.
The headlines, it's always market new highs, market new highs. So when you're just seeing headlines, everything's great.
It's one of those perfect situations where Wall Street doesn't align with Main Street.
Yeah. Well, let's see where we are next quarter. That's because we'll be through the holidays at that point too. Yeah. All right, guys, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.